Hello ladies and gentlemen, and welcome back. Well, as many of you may know by now, 2022 has really been marked by inflation and understanding interest rates. Now that we approach the end of 2022, we need to look forward to 23. What's the storyline going to be? Well, most likely it'll be around earnings. And if earnings aren't good, what is the Federal Reserve going to have to do? It's most likely going to need to cut rates. And this is the current expectation of the market. So in today's video, we deep dive into what happens after a rate cut may occur and whether we've seen the lows for the SP 500 and other markets around the world. We'll also be covering this very critical zone ahead of news and our expectations of the two main areas that you should be watching. Well, welcome back everybody to the Daily Show. We'll be talking about the lead news, macro, and of course indicators today and the key levels that you need to be watching. Just a quick reminder though to follow us over at FX Evolution on Twitter. We're sharing a whole bunch of extra charts over there, and I think a lot of you will be very interested. This is one of the ones that we shared over the last 24 hours, and it has to do with probably the most important thing to understand right now, and that is rates and where the market expects the Federal Reserve will be over the next 24 months. As you can see, things have changed a little bit over the last couple of months. We've gone from being at a lower overall terminal rate, that's where the interest rate will end up being, to a higher terminal rate, sitting at around 5% to 4.8% for the Federal Reserve in 2023. After something like May, though, into June, it's expected that we're going to be stopping inflation, and inflation will be dropping at the same time. The Federal Reserve will have to make up for what is no doubt a sickness in this economy. The market's moved from being concerned about inflation to now being concerned about a sickness that's becoming widespread and potentially systemic. And you can see that the cut expectations here continuously get worse and worse and worse. So each time and each day, realistically at this stage, the damage is being done, and we can see that represented in these charts. Let's take a look at what really is happening here. Here's a great chart. We know that used car sales prices went through the roof through 2020 and 2021. Well, that's stopped. Now we've got a decline of used car sales, even new car sales, and this is showing us demand destruction in full force in something that I think most of us see in our daily lives. So it brings us to the question, well, what happens during a Fed pause and what happens during a Fed cut? So historically, when the Fed has hit its terminal rate, that is around that 4.8 to 5%, historically markets have actually risen from that point. But then when the Fed starts to cut, which is now the expectation of late 2023, they have fallen. And you can see here with this chart that we've got on the screen that things are getting very serious. Trading days from the first rate cut to the S&P 500 market low have been on average 195 days later and an average of another 23.5%. Imagine taking what we've already lost on the market this year and potentially doubling that. That would be pretty serious. Now, as we know, it's more about the Fed pausing, potentially markets going up, then dropping. So it's all relative to where this 23.5% happens. But these are some of the data points that we've seen in the past. Here are some Fed pauses that have occurred and what's happened since that point. And you'll notice that often there were rallies. Here's one that's about 11% size. There are other ones that have incredible rallies during the pause period. But then once the cuts start, the drops happen. And I think you can probably see why a lot of the time the markets are dropping. Some of these rallies during the Fed pause are significant. So this brings us to the question of how does 23 look on a chart? And I'm from Australia, as many of you would know, so I'm going to go with potentially the kangaroo style market. That is a market that goes up very quickly and then goes down very quickly and can be difficult to navigate unless you're a trader, an options trader, or somebody that is very well aware of the risks and the majority of what's probably going to be happening. Now, as we've been mentioning recently, we're doing a bit of a giveaway coming into Christmas, so make sure if you're interested, it's totally free to enter. It's something for us to say we're giving back to the community, and we just want to say a massive thank you for your support through 2022. So if you are interested in any of our courses that we offer, we're giving away one of each of the main ones, and all you need to do is follow the links in the description and pinned message down below, and you can gain access, hopefully, to one of those prizes in the future. We'll be drawing in only about a week's time during one of our live streams. So over the past year and a half or past half a year, what are the things that have been occurring? Well, of course, it's a record number of downgrades. We started to see downgrades come through mostly through the highs. Markets started to say, well, you know what, maybe the S&P 500 targets here are not going to be as significant. We're going to need to maybe say, okay, growth is slowing. And at this stage, the decline of the downgrades has become significant. It's actually the record over really in recorded history here that you can see. So something that's very important, the rolling 6 month is not looking too good. Now, if that continues to happen, we see price compression, and that brings us back down to PE ratios that are hopefully around 1 standard deviation away from the median. Now, do remember that even though a lot of people don't look at PE ratios or PS ratios over the longer term, if you know that the average for the S&P 500, let's say, is around 16 to 17 in forward, and it goes down to something like 14 or 13, as a longer term investor, you have to be believing that fear is becoming in the streets at that point, and that they're the opportunities that really seasoned veterans start to look at it with really clear, non-biased views. And that's something that we do try to bring into this channel as much as possible. So is this a bad start to the month? Frankly, yes, it is. December hasn't been all peachy in terms of how things are going so far. It's actually the worst month start since 2011, and the S&P 500 has fallen a few days here. Is this anything of note? Well, back in 2011, we actually dropped during the first start. We had a little bit of a recovery afterwards, and then you can see that we did have a further capitulation fall after that event. And that's what a lot of people have been looking for in 2022 and possibly 23, a high VIX, a capitulation style event. Here's some of the rotations that we've seen in the last 24 hours and of course the last few weeks. The first one here is that technology and semiconductors are doing well. I'm watching, as I'm sure many of you are, semiconductors incredibly closely. The chart is very interesting. And if the chart does fall under some of the levels we discuss later on today's video, I think we need to be paying a lot of attention. What's been doing the best over the last months? Well, it's been gold, which we certainly were very, very bullish on here on the channel. And energy has started to tailor off, which of course we also have spotted recently. Our belief is that energy may continue to actually drop. Gold probably will remain strong through the next few months. It's into a very good period of time for it, but there may be pullbacks in between. But notice still, things that have done incredibly well: healthcare, metals, and we've even got staples and some of the more defensive sectors holding a lot of the bigger money at the moment. Remember, 401ks or super funds or pension funds around the world, they have to be invested. What are they going to be buying? When they buy defensives or they buy stagflation style plays, which are the metals and gold, that tends to lead into this real potential here for a defensive play moving forward. S&P 500 is at critical and VIX is still very low. Speaking of VIX, let's talk about the Volatility Index. It's low. It's sitting just above the 20 area in terms of it broke that zone. We're now just coming down a little bit. The big thing with the VIX, although we don't technically analyze it that much other than highs and lows, it did something that happened previously. It broke through the downward channel, just like what happened over here all those months ago during the August highs. Remember, VIX correlated to the stock market, such an important zone, and it's great for all risk on assets and risk off assets to understand whether the market is, let's say, greedy or fearful. That's really what the VIX is showing us. Yields continue to hold. That's really the story here. As we saw before, the yields in the back end are starting to drop a little bit more, showing that the Federal Reserve is going to have to act and act harder to support the economy. Some of you may think, well, that's a positive sign. And again, the stats would say when the rate cuts come, there's a drop, but that usually is a drop that you need to seriously consider as an investor, because while it may drop 20% or from those periods on average, it ends up being the turning point. That could be really the pivot that everyone's looking for. It's not just the pivot, it's then after that happens, getting the drop and saying, okay, this is the time where even though everything will look horrible, things are actually improving in the markets. Let's take a look at high yields. What's going on with high yield bonds right now? Look, they're holding pretty well. All things are relative though. And what's happened is because the expectations of the bonds market is that there'll be rate cuts through the back of 2023 into 2024, people are starting to buy bonds again. LQD doing much better than high yields, which is again expected because these are high grade corporate bonds. If we take a look at treasuries, which is usually a safe haven, hasn't been for 2022, they've been skyrocketing. We've liked treasuries for a while now. If you're going to trade treasuries, it's usually not the way to do things. Treasuries are generally a medium to long term kind of approach, but there's still upside in these. What the hope is at this stage is that we'll kind of hit these levels. The FOMO might come out of the markets a little bit. We see a drop in treasuries and then possibly a return back on later. But as long as everything still stays on board for what is expected, which is a sickness in the economy, rate cuts, it makes sense that people are going to treasuries. And it also makes sense that high yields, although they're going up, are not performing that well because really there's a lot of junk bonds there. The risks are still around in the market. So what is happening is the market's moving to the least risky bonds, and that's where the money has been found. Let's move over to the US dollar. So there was weakness in the last 24 hours, and this is a very important point. And actually, it's a contradiction. It makes the dollar very difficult here. You've had that kind of high area, higher high, and then of course a breach of the low that's occurred here. This kind of brings us to the point where if we go to like a 105.50 or 105.40, further weakness may ensue around that area. But at the same time, we've also tested off these highs here, which we have the alert for, which is pointing towards somewhere in literally the area we are right now, finding buyers. I think DXY is just awaiting the news. We'll talk about PPI later, but US dollar, very tough next 24 hours. Much clearer, I believe, after this bit of news on Friday. What's starting to get a little bit better though is gold. So gold has come back up to the perfect area. This was the box zone that we spoke about in the last video. We expected gold to get back into that 1790 to 1795 zone. It has done so. And this has been where that drop base kind of drop has continued. This was supply. Supply has been reached. Market has come down. Which alert do we want to be setting after the news to know that gold may weaken at least temporarily? The idea would be to get a new low, and that's going to be around the 1780. So what I guess the biggest play would be if the market was to weaken would be to see the market go down below here, possibly do a rally, and then drop off. Now, if you're a long-term gold bull or medium-term gold bull, I wouldn't worry about this temporary drop. It's more of an opportunity than anything else. Gold has been incredibly strong. Compare it to other things versus the US dollar, and you'll find gold has found the strongest buyers. But it did get back to this zone ahead of news. It's at critical, ahead of news. It makes sense. It's the age-old story. We move into that point. Now, what's not looking good? It's got to be oil. Oil sitting at 72 a barrel, a new low, weekly close here, very important. We'll see how that ends up in the next 24 hours. If you're short, you don't really have too many reasons to not feel pretty comfortable about where we think potential is. And we've spoken a lot on this channel about 65 and 75 a barrel. We reached 75 a barrel. Now we look for 65. And I know a few of you in the comments really hated on this one when we were discussing it pretty much for the last 6 months. But this is what we always expected. Demand destruction coming through on oil, regardless of whether OPEC, regardless of whether Biden's got a put on it or whatever else is going on, oil cannot withstand very easily demand destruction. And remember, central banks around the world have been aiming for this. That was their plan. Let's go to the 2 hours just to understand where rallies have been met and sold. Again, this previous little level here, you can see that 74.50 a barrel. We spoke about that in the videos. Very key. We've also got that 77.50, very key. But for now, it's just a series of lower highs and lower lows. No signs yet that oil wants to turn. Still very bearish. Let's move over to Tesla. Now, this is the stock that is critical. It reached the gap close in the last 24 hours. We just tapped under 170 for Tesla. We weakened into that level that we discussed for a long time. Oh, it's now or possibly 135, 136 for Tesla. Again, people aren't going to want to hear this, but it needs to find the buyers right now. If the stock market doesn't actually rally, Tesla's looking very sick, along with consumer discretionary in general. Let's take a look at the weekly to show you what's at stake. If markets get underneath here, there's not much holding it up to around that 135 structure on the left-hand side. So I think this is going to be a big concern here for markets. And again, a new low, especially close, could bring a fair capitulation down to these areas, followed by, I think, some buyers recommitting themselves to Tesla. Make sure you subscribe to the channel because we'll be following along Tesla with a huge amount of the options coming into the biggest month, trillions at stake, trillions of dollars at stake across options moving forward to the 16th of December. This is a big one, and I think it's going to be potentially fireworks. Another stock that we're watching closely has to be Apple. It continues to do a series of lower peaks or lower highs. Weakness, there was the shooting star we spoke about. No new low underneath at 140, so a little bit of a rally. But if we end up getting underneath this 135 zone, I think you've got to think about, okay, this is a sign that weakness is coming through. 134 is the actual area. It's not looking good on a chart. You go to the weekly again, it's starting to potentially look weaker, but this is such a straw that breaks the camel's back area. Getting through here will most likely mean the markets are starting to tank, and there'll be a huge amount of volatility and fear in the streets if such things occur. Semiconductors will also show us that. So here's the consolidation that we've spoken about for weeks now on semis. They had a great 24 hours, but if they break underneath this just above 210 area, we'll get the price. If they break underneath over the top of 212, I think that's starting to look like, okay, this was distribution. Now we go to fill gaps, push the market such as the SP 500 down to 3750, which would be around this area for semis, and we'll find out whether realistically at that point buyers are willing to recommit. The same thing going on with the energy sector. Distribution we spoke about the other day. We got really good signs here. That's a fantastic example to screenshot, keep in your mind, and then replicate in the future, because that's a stellar kind of entry. And it's weakening still. Rally was met by instant sell demand. A relatively decent day for the SP 500 and NASDAQ. It wasn't so for energy. And energy could continue to fall down at least to the $80 mark here as a sector. Then we'll find out the next big move. Consumer discretionary versus staples. How's that looking? Well, again, weak. It just shows you the American consumer, according to the market, is sick. 1/3 of the American economy is the American consumer, 2/3 is services. This is a good representation, I believe, of the American consumer. Discretionary purchasing versus staples. And it shows you that more pain, at least for the economy, maybe not the market, but for the economy, is expected. Otherwise, they'd be buying consumer discretionary. The DAX is holding as best it can. The old economy, such as the DAX or the Dow or the FTSE, they're doing really, really well. The ASX 200 as well, holding up very well. If we start to see energy tip over more, or we see metals go out of phase, that is things like, general mining metals outside of gold and silver. We will be doing a special on silver coming up as well. I'm pretty keen on silver. We'll have a look at the charts. Any silver bugs out there, you might be like, ooh, I like what I'm seeing on these charts. Fair enough. But here's DAX right at that supply. Continues to be a struggle point. Setting alerts above here will probably trigger further rallies. So we know that we're struggling with this area. We have to be open to both ends. At the moment, things look weaker rather than stronger. Let's move over to the NASDAQ. We got a new low on the NASDAQ in comparison to the SP 500, which usually gives the better signal. To put things back in perspective, a long-term investor, you're only looking at, 10% off the bottom for some of the most favored stocks of retail traders out there. And it shows you that, again, we're not recovering with consumer discretionary or technology in general. Semis have been the only decent recovery in these more innovative companies. If we have a look at where we are, we've just rallied a little bit. I kind of expect us to tap this 11,750, and that's to be where bears really sit here. It's found some buyers, but let's have a look at the S&P 500 to put things in perspective. The weekly close is super important. Will this weekly close be super bearish and engulfing underneath 3,900? That would be a huge close for the S&P 500 should it occur. We do want to see a bearish engulf. If you are a bear, We know this trend line has been pretty much the best level in 2022 for most markets to predict the biggest turning points. And we know that it's basically having a war between bulls and bears right now. We can see it on the charts. Look at the consolidation. Look at the way that it's structured up. Even here on the futures market, you can see where the buyers have committed and where the sellers have committed. This 3900, 3910 we spoke about in the previous video ended up being support. It was quite good. It's actually a great buy in there in the previous session. Congrats to anyone that was doing that one. But where do we run it to? I think 3990, 4000 could be a very big problematic zone here for markets such as the US 500. And coming into the PPI, we're going to most likely find out what occurs through here. So this is going to be a very important zone. 3990 for the buyers, they still should be committing around 3910, 3900. I don't think you want to see a new low. So if we get underneath 3910 this time, it's probably meaning that the bears are in control, and then we push down, and ideally we would move to 3750, which we'll talk about later on in probably the weekend video. So definitely come and watch this one. What's going on for futures coming into the Friday expiration? Well, we know they're all over the place. We've got 400s, 405s, and 410s being the main call strikes. The best point for the market's where it is right now in terms of maximum pain or best options expiration, and a 390 would be the put wall that you would hope that markets stop at. Now, if you go to the 16th and we scroll down here, and I think it's almost 6 million total open interest amount. That's a massive amount. We've got 400, 420. Notice the calls are taking over from the puts here, so people are still starting to buy, and 380s being that really big put wall. So if we go down to something like a 375, in the next week, we have to expect by the end of the week, it probably tries to pick up and hold above 380. That would be the key. On the top end, if it goes ballistic, it's unlikely that 420 will be breached at any rate. So again, if markets start going ballistic, we've got some key outlier points that we need to be watching on these charts. Let's move forward to Bitcoin, take a quick look at Bitcoin, what's going on. Nice rally, a new low was formed. I definitely thought that at this point we would start to see, while rallies would happen, expectation is set, that we would then see bearishness. That's still possible. Is this all part of what we would call a distribution range? Remember, we have the highs here. Is this what we call a UT or a UTAD in Wyckoff distribution? Wyckoff distribution is very difficult to sometimes spot during the sessions. I usually like to see on this side here a series of lower highs coming through. That's not what's happened, but the news will sort this one out. A new low past this point, you'll have a fair idea that this was all part of distribution. Again, that's when you would expect capitulation. If a new breakout does occur, markets will also be rallying, you would think, at the same time. And the next stop for Bitcoin is probably something like around 18,000. So yeah, there's bullish and bearish implications. I still think I'd be leaning the bearish side, but this area here it's becoming more clouded after that rally beat down and took out that 17,200 high. For the news, here's the PPI, the core PPI, the prelim UOM consumer sentiment. Notice the times in the US. Make sure you've got your New York times set 1 hour before the market Friday and then half an hour after the market opens. If we also are just thinking about the weeks ahead, make sure you always scroll through and understand what is going to be happening in the weeks ahead. There's a whole bunch of big news coming out, but mostly it is going to be realistically that big options expiration and CPI that you'll be looking at Tuesday, December the 13th. It's the number that everyone looks for. Core CPI and CPI, a massive, massive one. You've got to watch the weekend video. We've got to be ready for this, and we need to know where those weekly closes do happen, especially Tesla, semiconductors, and the SP 500. Just a quick reminder to finish up the video today, subscribe, smash that like button, and of course, you've got to be in it to win it, yeah? So make sure you check out the FX Evolution competition. 4 prizes, totally free to enter. Get it done. We'll see you in the next one. Bye for now.